All right, welcome back everyone to this high-yield explainer. We're going to treat the sometimes complex world of corporate debt structures like a dynamic university revision masterclass today. If you're prepping for exams or just need to really lock down your foundational accounting knowledge, you are exactly where you need to be. Today, we're putting on our professor hats and tackling Unit 3, Accounting of Debentures. So, get ready to take some mental notes.
Here's today's syllabus on the board. First, debentures basics and types. Second, the mechanics of issuing. Third, special cases, like collateral security. Fourth, interest, taxes, and losses. And finally, redemption, which is how we actually repay the debt.
Okay, diving right into Section 1, Debentures, Basics and Types. So, when a company needs cash and takes a public loan, it's essentially issuing a debenture. Now watch out, because this right here is a classic exam trap. You absolutely have to remember that debenture holders and shareholders are sitting on entirely opposite sides of the corporate table. Debenture holders, they are your lenders. They lock in a fixed interest rate, and here's the kicker. The company promises to pay that interest even if it's bleeding money and running at a loss. Shareholders, on the other hand, they're the owners. They take on the risk of ownership, hoping for a cut of the profits through dividends. But if there are no profits, literally no dividends.
Now, companies offer a few different flavors of this debt. Make sure you memorize this breakdown for your exams, especially the trade-offs. Under security, you've got secured debentures. These are backed by hard physical assets of the company, making them way safer. Unsecured ones offer no backing at all. Riskier, for sure, which means they naturally have to offer higher interest just to get investors on board. Then look at convertibility. Some debentures can actually miraculously transform into equity shares later on. We contrast those with non-convertible debentures, or NCDs, which are strictly cash-out only. And finally, transferability. Registered debentures have your name officially on file, meaning you need the company's okay to transfer them. Bearer debentures, whoever physically holds the paper, owns the debt. So definitely don't drop those on your walk home.
Moving right along to Section 2, the mechanics of issuing.
What's really fascinating here is how these financial instruments are actually priced and pushed into the market. It's not always a simple one-to-one exchange. A company basically has three pricing strategies. It can issue at par, meaning it's priced exactly at face value, say a clean 100 rupees. Or it can mark it up and issue at premium, meaning the company collects 110 rupees for that same 100 rupee face value debenture. Finally, it can be sold at discount for maybe 90 rupees. And listen, this discount is absolutely crucial from an accounting standpoint because it creates an immediate trackable loss for the business right out of the gate.
But wait, debentures don't always mean cash is changing hands. This is a super high-yield concept you shouldn't forget. Companies can actually use debentures like a currency of their own. Instead of handing over cash to pay vendors or reward promoters or even settle a corporate takeover, they just issue debentures. The journal entry for this is straightforward, but trust me, heavily tested. You simply debit the vendor or asset account and credit the debentures account. Easy as that.
All right, Section 3, special cases, focusing on collateral security.
Now here's a highly tested scenario that constantly trips up students when they're balancing the books. Picture this. A company goes to a bank for a loan, and the bank wants a solid guarantee. The company can actually pledge its own debentures as collateral or a mortgage. If they do this, it is absolutely vital to remember that these don't become real liabilities right away. They sit quietly as a contingent liability. On your balance sheet, this is literally just a footnote. It has zero impact on the core liability numbers unless, and only unless, the company defaults on that primary bank loan. Only then do those debentures suddenly spring to life as an active liability.
Section 4, Interest, Taxes, and Losses.
We're now stepping into the active life phase of the debenture. This is where we track the money as regular interest accrues to the lender. And, well, inevitably, the government steps in for its cut. Let's run through the exact mechanics of tax deducted at source, or TDS, with a practical example. Step 1. We've got a 10% debenture issued for a 1 lakh rupee principal. Step 2. We calculate that annual fixed interest, which is exactly 10,000 rupees. But hold on, the company doesn't just hand over that full 10 grand. Step 3. Income tax law dictates the company has to hold back a 10% TDS. So 1,000 rupees is sliced right off the top and deposited directly with the government by the company.
So the big takeaway here is that the final payout actually hitting the lender's pocket is exactly 9,000 rupees. The company then hands a TDS certificate over to the debenture holder so they can claim that 1,000 rupee tax credit later when they file their own taxes. It's actually a pretty seamless system once you wrap your head around the math.
Now think back to that discount on issue we talked about a minute ago. Or what if the company promises to repay the debt at a premium later?
Both of these represent a loss or an extra cost to the business. So why not just take the hit all at once? Well, to understand why we write off these issue discounts or redemption premiums over time rather than in one brutal blow, we have to ground our math in the fundamental matching principle of accounting. This rule dictates that an expense absolutely must be matched to the period in which it brings a benefit. Since the debenture provides funding over, say, several years, we spread that loss out, debiting the profit and loss account just a little bit each year over the entire life of the debenture. So let's see how this actually plays out on the balance sheet. If you're spreading a loss out over 5 years, what happens to the leftover amount in years 1 through 4? Well, whatever portion of that loss hasn't been written off in the P&L yet just kind of hangs out on the balance sheet. We classify this precisely as a fictitious asset, which is honestly proof that accountants do occasionally have an imagination. It's not a real asset you can sell. It's literally just an accounting placeholder, patiently waiting its turn to hit the P&L.
And finally, Section 5, Redemption, repaying the debt.
We've reached the end of our debenture's life cycle. Redemption just means the agreed period is over and it's time for the company to pay the piper. And just like the initial issue, redemption comes with its own pricing terms. Repaying at par means you're giving back the exact face value, a nice clean break with no gain and no loss. Repaying at premium means handing back more than the face value, meaning that extra cost is a straight-up loss for the company. You could, in theory, redeem at discount, paying back less than face value, but realistically, the law rarely lets companies shortchange their lenders like that at the finish line.
So how does this repayment physically go down? For your exams, you absolutely need to be able to list these 4 methods of redemption. First is the classic lump sum, where all the debentures are paid off at once on the maturity date. Second is by installments, where the company pays it back in parts every year, often doing a random draw of lots to pick who gets paid when. Third is the open market purchase, where the company just strolls into the market and buys back its own debt. And fourth, by conversion, where the debt is wiped clean by converting it into brand new equity shares for the lender.
To wrap up this explainer, I'm going to leave you with a critical question that really tests your core understanding of corporate risk. If a company goes bankrupt tomorrow, would you rather hold its equity shares or its secured debentures? Really think about who gets paid first based on everything we just covered. As a lender with secured debt backed by hard assets, you are right at the front of the line. But as an equity shareholder, you're the owner taking on the ultimate risk, sitting at the very back of the line. Keep that risk-reward dynamic front and center in your mind as you study. Thanks for joining me for this masterclass, and keep up the great revision.